welcome our host Vince from Kronos Research. And we have 4 panelists: Jeep from Rysk Finance, Aerhy from Pos Finance, Gautham from Polynomial, and eBay from Predy Finance. eBay? Are you here? Oh, okay, cool. Okay, so we can see that there are 2 squads here, option and power perpetual. I believe this is gonna be a very exciting panel. Let's welcome them.
All right, test. All right, I guess they saved the best for the last. We're gonna have some fun today talking about DeFi options. I'm your host for this session. My name is Vincent. I'm a Kronos Research COO. Kronos Research is a high-frequency trading firm. We have a bunch of traders here. Anyone interested in talking about trading, happy to chat after. I'll pass the mic over and introduce yourself and tell us what does your team do. So.
Hey guys, I'm Jib from Rysk Finance. I'm one of the co-founders. I lead protocol engineering. So Rysk is sort of devoted to solving the systematic uncorrelated return problem. So a lot of crypto is very highly correlated. So if ETH moves, Bitcoin moves the same way. And so we're sort of building products which aim to solve this problem. We currently do that through our dynamic hedging vault and around sort of making options trading better for normal traders, market makers, and protocols alike. So yeah, I'm happy to talk more about it going forward, but I'll pass on.
I have a mic here. Hi guys, my name is Aerhy. I'm from Pos Finance. So Pos started back in 2020 with an options AMM, but now we are doing structured products using options. So yeah.
Hey. Hi, I'm Gautham. I'm from Polynomial. At Polynomial, we are focused on solving, building products so that inefficiencies in derivatives slowly go down. And we primarily have like 3 products at the moment. One is structured products, so call and put selling walls. We also have perps, and currently we are working on power perps, which are like an alternative for options.
Yeah, I'm from Predy Finance. Predy Finance provides like a hyper gamma trading platform composed by the Uniswap version 3. Thank you.
All right, warm-up question. Can maybe a couple of you guys describe the current stage or status of the DeFi derivative space?
Hello. So derivative space in DeFi at the moment is mostly perps at the moment. So I think over 1 trillion notional trades like fully everywhere, like centralized exchange and decentralized exchanges combined. In DeFi, perps haven't been a thing, but like recently with GMX and DYDX, like they have also been like increasing in volume a lot. So the major thing at the moment is perps, and followed by that, I think options are there. Options have like trade like 13 billion notional. So that's there, but like adoption hasn't been that much compared to like perps. So that's majorly like these are the 2 main products that drive the volume and traffic. And in terms of like the ecosystem wise, most of them are concentrated on L2s and Optimism and Arbitrum. They're like almost everything is over there. And there is also structured products which are kind of for retail. So people who want to put money somewhere and they just have a payoff in their mind and want to earn yield. And they are what I would call as like high risk, high yield kind of thing, and an alternative for yield farming. And a lot of people use that. But they've been slowly going down in the past few months because of a bear market and like all those things that happened due to that. But this is how the space is.
Also, decreasing the TVL is one of the issues. Is the interest rate of the U.S. Treasury. Even you put the money with bank, central bank, and then you can get a 4%. Who wanna go to the Aerhy or something? Put the USDC, get right now 2.3, 2.6, around that. Who wanna do that? It's a current situation. Even our case, we provide the leveraged like a LP position. Of course, user must lend the money from the lending pool, but we must get like a lender for the liquidity pool. But who wanna provide that? Even we using the same model with Aerhy, but we can pay the interest rate is 2.3 or something, 2.6, can reach the 4. But if you go to the normally bank, you can get the 4. How?
Yeah, I think DeFi derivatives specifically, for the vast majority of it, caters towards gambling kind of behavior, as opposed to what you'd see more traditionally with institutions hedging. I think most of the hedging activity is closer to centralized and OTC kind of trading, whereas DeFi, because DeFi leans more towards automated stuff, it tends to be much more focused on gambling and sort of users just taking on huge speculative positions to just bet on the price of a spot position, for example. So yeah, that's why I'd say DeFi derivatives at the moment caters to quite a lot.
Okay. Then I guess along the same line, can you guys comment on the biggest obstacles in the DeFi derivative space? We're gonna just go from you, and then the next question we're gonna rotate, so that everybody gets a chance.
Yeah, I think my co-founder Dan did a presentation on basically all the challenges there are, and there are a lot. For me personally, I think user education is a big issue. A lot of users kind of don't really understand options properly. They don't understand the benefits versus the perp. To them, sort of going 25x leverage is fine. They don't need to know what convexity is. Then also, smart contract risk, I think, is very underpriced and not really thought about too much. We've had maybe 5 or 6, major exploits in the past month, and yeah, it's something that sort of keeps on happening, and it's very hard to solve. So that's another thing. And then user experience also is pretty huge. I think CeFi user experience is far, far better than what DeFi currently offers. So I'd say those are kind of 3 things, but to be honest, there are way more I could mention. So yeah.
Yeah, I completely agree. One of the biggest challenges for me whenever we're working with the options AMM was regarding the user education. But on top of that, I think that how capital intensive the market is. Like, whenever you have to sell an option, you have to collateralize 100%. That's very capital intensive. So I guess this is one of the biggest challenges in attracting new people into the market, attracting liquidity. So that kind of goes along with the user experience. And also, in addition to that, the fact that there's not tools like portfolio margin, where you can compose many positions that require far less capital. That is something very important for us to attract people into options, but right now I do not see venues offering that. So I guess, yeah.
Hello. So from my personal perspective, we've been selling options for a year with a vault. And one thing is crypto is so unpredictable. So most of the times you make, 0.5% a week for 5 weeks. And 1 week you just lose 20%. And that just screws you. So the market is highly mispriced, is what I would say. So the LPs don't make profit due to a crash, very badly they lose. And the traders, longs are always paying a higher premium than somewhere like Deribit. And on the short side, you always have the, what you said, like the collateralization issues there, and also like you are also getting wrecked. So there is like a mispricing happening. I don't think it's like just DeFi, but like in general, like option pricing hasn't been that accurate. There is a lot of what you say, market makers and things like that who know the market beforehand, and they take advantage of people a lot. And if you see, like, there are a lot of option walls who sell directly to market makers, and they have been also, what you say, like, they know that there is way too much demand and they try to price it much lower, and then the retail gets screwed, and then the retail is like afraid of touching any of those products, and then they just go away. So that has been like the general trend which I have been seeing. So there needs to be a better pricing. The market is still very inefficient for something this sophisticated to work very well.
I just want to ask a question based off that. So you mentioned that just pricing off what you said, but the example you gave of like 0.5% gain and the 20% loss, but surely you can't really use that argument if your position isn't hedged. So like if your position hedged, that would have been lower, but you might have collected profit on the price alone. So like how can you sort of say that that's just a bad strategy? That's not necessarily bad pricing.
Yeah, like selling options weekly forever, yeah, that's a bad strategy, but that is the biggest DeFi product at the moment for options, right?
I agree. It's bad.
And also like the issue is like you're most of the time selling at a cheaper price than Deribit. That's also a big issue, right? Like why would you, like let's say you get like $1 million, and if you're selling on chain you are getting 950, it compounds over time, right? That's also an issue. There is like nobody really arguing it. Most of the time, like on chain options are like the pricing is bad, so they give token rewards to make sure like it's taken care of also.
But I'd argue with that specifically, it's only bad pricing because it's a bad strategy, because every single market maker knows that every week they're doing that 10 delta option strategy, so they front run the whole thing and they pull the pricing down. So it's more a bad strategy than bad pricing, I would say.
I mean, you can say that, but nobody's using any other thing. Nobody's using long dated options. I mean, practically speaking, like who is using it?
That's because of a capital efficiency problem, though, necessarily.
I mean, you can buy them, right? You can buy like a 1 month expiry. Nobody's buying, nobody's selling. Like, I mean, if there is no two-sided marketplace, who's gonna pay for it, right? You need someone to be willing to buy it and someone to be willing to sell it. Nobody wants to buy it, nobody wants to sell it. The pricing is obviously going to be very bad. I mean, it's just like that option is generally in the short-term option expiries. Even if you remove the walls also, generally like even in Deribit also, like the volume is generally on the 1 week expiries, right?
I mean, I think that longer dated options are actually a lot better than short dated options. Like at Rysk personally, we focus quite a lot on long dated options, and we actually do sell them quite well. And the pricing is actually significantly better sometimes. But like I think the main issue with why you don't see long dated options that much is the capital intensity of options protocols at the moment, which is kind of, again, it's.
What do you think about this scenario where like, let's take 1 year back, it was 4,000 at some time, then it went to 800, and then it went to now 2,000. How do you like even predict as a seller what is going to be the price? Like, think about from the perspective of the other side, right? As a seller, I am selling 1 year option. How do I know? This thing is like, it's like a time bomb. It can go up so high, it can go down so high, and you are a seller, and if you sell like 4,000 calls for 1 year from now, you are losing like 60% of your capital, right?
I mean, but that's just volatility price.
Yeah, but the volatility is way too high for long dated options. That's what I'm saying. It's way too, like it's 80%, I think.
All right. Yeah, I like the discussion. Keep it going. So, like we talked about some of the obstacles. You guys mentioned user education or liquidity or like scalability. Maybe we'll just pick one and go down a little bit. Let's talk about liquidity. Like what do you guys think count as the organic flow And how do you guys think that, what's the best way to attract liquidity or organic flow? Yeah.
I guess the easiest way to do it is like through liquidity mining. That is something Pods was very against because we don't believe that a protocol should, maybe kind of controversial, but should release a token if you don't really have utility to it, and you're always looking to finding PMF before release that token. So that is the easy path in order to attract liquidity. But as I said before regarding the obstacles, I guess that once you solve all the issues regarding capital efficiency, like portfolio management, having like features like this in the space, I tend to believe that liquidity would come more naturally. And also regarding like this organic growth, just like Jip mentioned, like the DeFi space right now, DeFi options, people are using it for gambling. But options are way more than that. Like just in Taeyeon's talk, where he was talking about like what's the impact of hedging for DAO treasuries. Once we start seeing DAOs doing that, like actively looking to hedging, using these instruments for that, and not just for exposure, just for kind of easy money. I think that's what I would consider like organic growth, because of course hedging is way less sexier than having leverage. Of course, I want to get 100x and then win like that, but at the same time, 100x, when you're losing, you lose way faster. So bringing hedging into like kind of day-to-day life, like you naturally consider it as part of your like treasury management strategy. That's what I would see, not only treasuries, but you on your own portfolio. Like how many people do hedge here? I think not many people. I tend to believe from previous user interviews I had. So once people start using options in that way, in a natural way, I think that's what I would consider like natural organic growth.
Yeah, I second everything Aerhy said. I think really all flow is organic flow. I think on top of what Aerhy said, I think a big thing about attracting liquidity is just having strong product and strong strategy, especially on the financial strategy. And hedging does play a part in creating a good strategy. And so if you have multiple protocols who are using these derivatives to hedge or using them to speculate, then you suddenly have an organic market which is using each other to hedge their products. And so that's where hedging can fit in quite nicely in DeFi, where users who don't normally hedge can deposit into one of these products and it basically handles the hedging for you, which is a big part of sort of DeFi automation and its power there. So yeah.
The question is like how will liquidity come, right? Like when will liquidity come?
Yeah, liquidity and organic growth. What do you
I
consider
think
that?
when the next bull market comes, centrally.
Yeah. What is the question?
His question is like, what do you think will bring liquidity?
Liquidity. Liquidity is in our protocol is one of the issue is like as I told is Uniswap version 3's liquidity is exactly same as like option short, and then based on the calculation of the Uniswap version 3, implied volatility is cheap. It's a main issue. Cheap means selling the like a short position is less premium. So now less people want to do the liquidity provide to the Uniswap version 3 because IV like a premium is cheap. It's an issue for now us. And then it's not investment advice, but right now many people want to making like gamma long against the Uniswap version 3's IV because it's easy to make money. It's not investment advice, but like current situation.
So you're saying like if you those who provide liquidity are like making the volatility on Uniswap very low. That's what you're saying. IV on Uniswap is low. Uh-huh. How much is it? How much is the IV?
For example, let's say Ether and the USDC pair is like last week around 30% or something.
It's very mispriced now. Right? Options are 70, I think. Right?
So, coming from a TradFi options trader, I was doing that for like over 8 years when before Kronos research. You can sort of categorize, liquidity in 3 categories. You have the big institution hedging, which we sort of mentioned. Then we also have just retail speculating, specifically on the Tesla options or GameStop. They love the 0-day options or the short-dated. So, for speculation, they can accomplish the same thing through perps, right? There's like 50 times leverage. And for institutions, we have yet to see like really big institutions come in, whether it's regulations or things like that. I guess the third category would be like people chasing yields, which is sort of what we've seen so far in the DeFi derivative space. People selling weekly options. In a way, they pick weekly rather than a year out because there's more theta, more decay in the front. It's a bet, implied vol versus realized vol, and people can see their P&L sooner and everything. You guys also mentioned treasury, right? Like with different altcoins, they can work with those different DeFi, weekly options selling platforms in a way to generate additional yield for their treasuries. If we think that CeFi is like the history or sort of a mirror or guidance for the future for DeFi, I guess we need, like we mentioned, we need bull market to come back, which means we need more retail to speculate. We already have sort of a yield generation platform, even though the TVL has been decreasing. Maybe the next big thing is the institution adoption, right? And then they will provide some additional flow. And then, going back to circles, we mentioned there's a smart contract risk and all those things. But we'll see. Liquidity begets liquidity. So, yeah. Okay. So for next one, let's talk about what are the technological hurdles maybe you guys are facing and your guys' approach to overcome these.
Yeah, I can probably talk extensively about that. I think I won't. I'll break it down a bit. So I think like the computation on basically every blockchain, L1 and L2, is sort of, it's still limited. The fact you have to pay for computation is a huge limiting factor. Stuff like portfolio margining is essentially very, very, very difficult. I mean, there are some teams who are working on very cool things for enabling portfolio margining on a blockchain, but that's still going to be very intense. Other products are doing it off-chain and then passing it on-chain, but that's sort of just like a bit of a middle ground. So I think that's one thing is just computation is just a nightmare. So that affects portfolio margining as well as like getting actual like data on chain. So for example, like there's no real way beyond just pushing to an oracle to get volatility yet, and that's mainly because of a lack of liquidity on chain. So it's not really viable to sort of come up with volatility purely from on-chain stuff. And then, yeah, I'd say those are two main things that come to mind. Then obviously security is the obvious one as well.
Yeah, everything Jib said, and maybe I don't know, finding a way to create like under collateralized options or something like that to of course like portfolio margining is very complex, so maybe a mid ground would be starting with under collateralized options, but then also you do bring some risk into that. And yeah, yes, that's.
Hello. I would say the major issue is like blockchains are really slow, even now. That just means that someone can just go on Binance and come on chain and then just make easy money, and people do that, and then those who LP on the just get screwed. So in general, like a simpler answer is making an option is very, very, very hard and maybe not possible. That's also there. And so let's see what happens, but I think in the long term, if volatility and things like that go down, it will be possible. But in the short term, I feel like there is a need to increase the speed of blockchain. It's currently, I think it should go under a second. Right now it's like mostly 13 seconds. That's not very good, and people can like often use it to their advantage, and people lose money. That's one of the major obstacles. And mathematically, it's very hard to design an AMM, which makes sure that like there is like for example, like traders mostly on chain who are buying options are at a loss compared to centralized exchanges. Who are selling options are at a loss, and those who provide LP are also at a loss. And so it's like the model is not very precise. Like, you know, when you are LPing, like you are LPing to the whole option pool, and there is so many strike prices and expiries, and you take all that risk into you. And so at least like someone should make money, and that would be good. And that is generally like the biggest issue. But nowadays people are making sure that problem is not there by giving the native tokens of the protocols as a reward, so that, like, you know, some of that offset of what they're losing is taken care of. But still, I don't think it's like there yet. It's this one. How do you technological hurdles in DeFi derivatives?
Technological? Technological, how should I say, it's making the cause simple. It's one of the most important for us. To be honest, even like as I show the formula of the Uniswap, it's very simple. It's difficult to attack. It's readable, and then like even like if someone in our, not only us, many people maybe like try to do the challenge, try to solve some challenge, and try to do something difficult. But on that time is like I don't feel like we don't use much technology. Like try to as much as possible like simple. For example, as I say, is in our case is a Predy finance. Is at the beginning is there are a lot of like parameter like strike price or some even if we like provide the option, of course we must have a like a strike price. If we modify like central exchange like a debit, of course we must have a expiry date. But if we come to the DeFi, first we cut the maturity date. It means a perpetual, right? Then like second, we don't want to have a like a parameter like a strike price. So we change like a square root or something like an index. So it's like if like we play like a central exchange, they have a lot of choose. But in DeFi, our like option is very limited. It's maybe we must understand.
Basically, you're trying to simplify options and make it easier, like less user education.
Yeah. For example, let's say is what Uniswap does is just cut the price on source code. What I mean is Uniswap shows the price with just amount of the token A and B. In the code, we don't find any parameter like a price P. It's what they did. It's like if we just using the blockchain with like perform like a central exchange with using the Chainlink Oracle, sometimes we using the P. Is the price is as our Oracle. In source code also we have a P, but it doesn't work. I don't want to say something negative about the Chainlink. Sorry.
sorry. But what we did is like that. If parameter is many, of course, there are a lot of some point to attack.
Okay. I guess this is sort of related to another the obstacles in a space with scalability. What do you guys think about scalability? Are you guys maybe it also relates to the target audience? Are you guys try to target retail or institutions? Yeah, I guess scalability is the key word here.
Yeah, scalability when dealing with, I feel, derivatives that, like options, for example, they have expiry date. So, I don't know, you got to deal with rolling the options, changing positions. Of course, like right now, gas is cheaper than it was like last year, but still it adds up. So I feel like it's very complex to have these instruments on mainnet right now. I remember that when we had the options AMM pods back in 2020, adding liquidity to the pool was around $300. So that's a lot. Like, it's not feasible at all. I've heard from some users back in Brazil that they're very scared of using protocols on mainnet because they're afraid that the price of the gas will go higher and their funds will be stuck there. So scalability, especially for instruments like ours that need constant management, is very important. Right now, pod is only on mainnet, but we do have plans to go to other layer 2s to solve these issues. But yeah.
Yeah, I agree. I think L2s solve a lot of the scalability issues we see. In terms of, we also asking about liquidity scalability. Yeah, so I guess L2s from technological scalability is the main thing. For liquidity scalability, it's actually, for options specifically, it's the capital efficiency is kind of the main thing that needs to be improved. Like, if you take Ribbon, for example, they collateralize, when they do a covered call, they collateralize like a 10 delta option with like 1 ETH. So that means that they're selling a $9 option and they're putting up like $1,800, which is pretty stupid. So that's one example of that's obviously stupid, scalability. And so just improving something like that so that it's only 3x could completely transform the amount of profit and exposure you can generate off a smaller amount of liquidity. So I think in terms of liquidity scalability, in my opinion and Rysk's opinion, I think capital efficiency is the main problem to solve there, because once you solve that problem, you can solve a lot of other problems, like market makers will be more willing to sell on chain. Users will generate more yield. Structured products can use more of their liquidity to hedge as well as trade options. So I think once you solve that problem, you can get around a lot of the financial scalability issues of options. But yeah, technological scalability, I'd say L2s are doing a pretty good job.
It takes a long time to start up. Okay, so in terms of liquidity, right? Like what scalability issues are there? That's the main question, right? Yeah. So in derivatives in general, currently perps are there, but they have currently a scalability issue. Like over $1 billion, $2 billion, nobody's able to do at the moment. It seems like a lot, but when you are doing 25x leverage, 100x leverage, it's not a lot of capital. And so the issue in there is the model needs to be a bit more efficient, because you have 100, 300 million capital only, and then you are trying to, market. Essentially, the liquidity pool is trying to market make both the sides, right? Like the longs and the short. And there needs to be better risk management systems. Some things I've seen interesting was some people are playing around with funding rates. They are trying out different ways of doing funding rates, like funding velocity. So that was something interesting, rather than making funding rate the difference, you make it like a rate of change, so that it comes back to the price eventually. So that can be helpful, but still the hitting, like we have perps and almost every day OI caps are hit, so like there is always more people willing to trade, but there is not enough volume on chain, like not enough like liquidity on chain to do it. And from his point earlier, like if US government is giving you 4% yield, who's gonna put money in crypto? A lot of people have left, and most of the people who are staying are just doing it for earning yield and all. So that's one of the thing. And in terms of option scalability, like the issue is like the AMM and the model. So like people are trying a lot of new things. I think there are some people trying order book model because they think that might be the right way to do. I am not very sure because it depends on the market maker, and market makers are known to screw people typically. So there is a lot of things that happens. And so I think like from our perspective, what we think is what worked on chain for AMM is Uniswap. It's not something that based on order books, like that happened earlier as well. So I think like there needs to be a perpetual, because most things on chain with expiry doesn't work. So something that is perpetual, which works like option, so that people can hedge and get convexity. I mean, even gamblers who are willing to gamble away, right? Like Robinhood, like did so much trading volume, right? So something with a large amount of can do convexity, can be perpetual, and can be expressed simply in an AMM, that would be good. Because like Uniswap is very simple, as he said, like it doesn't take like 10-20 days to read upon it, and like most of the option products that are there, to read through the docs it takes 3 days, and you don't understand what is happening, you don't know the rest, all that stuff are happening. So you just want to make a very simple product that makes people understand the thing very well and delivers the same outcome that they want. I think something like that will come. I'm not sure like if we are doing it, but I think in the next 3-4 years someone will do it.
Scalability. Maybe I should say something different. Okay, so all you guys like a liquidity or something, they say, and then what I feel like, okay, let's it's not advertisement too, but last week there was ESA Tokyo, and then on that time our team joined the hackathon, and then what we propose is like between the DeFi, especially option and gaming, we combine and submit. The reason why we did this one, because if you see, if you like heard like GameFi or something like a play to earn, but what in fact is just like a gaming operator pays some money to the user, only that. But what we made is user come to the gaming, and then they just buy the item, and then this money goes to the Uniswap. And then behind that, earn the money from Uniswap, then item can earn the, like a mushroom or something, like we submit the ESA farm. It's just idea. But if it's like a liquidity come from the gaming or something, also like their money can improve the DeFi. Is that what we feel? As I say, is collecting the liquidity is one of the challenge. So if those people is focusing to DeFi, also because they don't need to pay the gaming operator don't need to pay the marketing fee to the user. All and the money come from the Uniswap to provide the liquidity. It's just idea. But if not only the finance guy, gaming people come to this industry, also they might make something change to us.
Yeah, I actually had a question of what Gautham said about scalability. I do wonder sort of what is the scalability of a power perpetual compared to, you know, sort of normal options, because the thing that I sort of, when I initially sort of read about power perpetuals is that, and just options in general, is like options are relatively easy to hedge compared to, you know, other derivatives, and delta one, you know, perps are also very easy to hedge. So like, but when we look at power perpetuals, the actual replicating portfolio to hedge a power like a a squeeze or whatever is actually very complicated, and I think that does drastically affect its ability to scale. So I was wondering what your thoughts on that were.
You're asking how to hedge it?
Sorry?
You're asking how to hedge it?
I'm asking about like hedging a power perp. It seems to like it's quite difficult, and it sort of limits its scalability, in my opinion.
I mean, like you can hedge the delta by using futures, right? And then like the gamma is what you're trying to get out of the power perpetual as well. So you're talking from the longs perspective or from the shorts perspective? Like
both.
So from the longs perspective, you're kind of getting asymmetric upside, right? Like you can just hedge it with, you don't really, like if it goes up, you make a lot more money than what you'd go down. It's like buying a call option, right? And when you are shorting, it works similar to a payoff like a DOV does, right? If it goes up, if it stays stagnant, and if it if it is stagnant or goes down, you make money, and if it goes up, you lose money. So if you want to hedge the short position, you can always like use a future position to hedge it. I mean, it's similar to how perps as well, right? You can create payoffs by combining it with other instruments. Like DeFi's main thesis is that you can combine major Legos and make cool and interesting things, right? So like what Predy is doing, you can use a Uniswap V3 position, you have a certain payoff, you can combine it with this. I mean, it's still like, I am not talking like this might be the thing. I'm just saying that it can be potentially something, because I don't think options are the thing. That's the only thing I know at the moment. But like other things are like, we don't know if it's going to be perpetual. It's still a research, right? Like it might be something else. I just think like, I even think like everlasting options are interesting. It's just like something needs to be there, but I don't think I am generally not very optimistic about the future of dated instruments on chain. Like it's not just options, it's just even fixed lending with the term. They are not getting adoption. It's just too much uncertain for people to put money there.
I mean, I'd argue that power perpetuals are far more uncertain than options. In options, you know what your payout is up front.
If you're a seller, not. If you're a buyer, yeah, okay. But if you don't have a seller, like where is the market?
But if you're a seller, then you can just hedge off the risk, and then that, you know what your payoff is. Like it's sort of,
I don't think.
Power perpetual, it's a funding rate that changes. So
yeah, funding rate changes, right? But it's more of an argument.
Perpetuals do make it unpredictable to hedge.
Yeah, that's true. But that's true. But why do you think dated futures didn't work in crypto while perpetual futures did?
Because as I said earlier, crypto is, as it is right now, is heavily geared towards gamblers, and they don't necessarily think about fees too much. So if you think about GMX, like we speak to GMX traders. So I think someone on our team did a talk with like 10 traders from GMX, and the vast majority of them didn't even know how many fees they paid on their last trade. And so if they're not even thinking about that, do you consider them sophisticated traders or just gamblers? And those gamblers aren't the same people who would trade fixed.
I mean, if you go and ask traders their trade, they won't say most of the time. But anyway, like if you look at the history of power perpetuals on chain, right? Sorry, perps on chain, right? They tried perps. Sorry, they tried futures, dated futures on the blockchain. It's just like perps are a better instrument than dated futures. That's why it exists, right? You can have 100x leverage. In dated futures, how will you have it? You need to have physical delivery. Who's going to deliver Ethereum to you, right, after every 30 days? Like perps are a better product than futures. Like someone, so you can think of like
it depends who you ask on whether for futures.
But then why is people not trading dated futures, right? It's there in almost all the exchanges. Like everyone is trading perps. Like it's not that Binance doesn't have it, people have it, but people are trading perps because perps are better.
In crypto,
for a trader it is better, right? Like it's kind of easier to think about, right? You don't have to take expiry into consideration and think how the price will change over at that time, and then how much it deviates and all those things. You can pay a funding rate, but the funding rate is kind of fair, right? It is more like you're paying premium based on the market demand. If too many people are longing, not a lot of people want the thing. So funding rate is like, its price is increasing over time. I mean, it's like, it's a much fairer mechanism than like buying a dated future and it's just like all over the place.
Yeah, I think I'm sort of playing off what we said about institutional being sort of the next wave of things, and treasuries as well, and they typically want a more predictable
I actually think perps are more predictable than dated futures. Like liquidity is not there. Like you need something that can work with low liquidity and can work. What is the point of buying something which you don't know will like? It's just a worse instrument. I mean, that's what market has shown us. One is doing $1 trillion.
The market has shown us for specific users. They are. I agree with you on that. But the specific market I'm talking about, which would scale it to a very large amount.
Let's take an example. Okay, let's take an example. Let's say I have a single staking pool, right? And I want to hedge my single staking pool with an instrument. Will I go and buy futures every week dated, or will I just short a perp and then just like keep it over there, like for crypto? Like
It depends on who.
Let's say you are providing liquidity to a single pool, like you lock a token and you stake it. You want to hedge the risk, right? What would you do? Would you buy futures every week or like dated futures, or would you just buy perps and then just short it? Isn't it just easier to buy perps in terms of like mental thinking?
Well, not if I want to keep my costs known.
I mean, you know the cost here, right? It's kind of fixed already, and you are shorting, you are actually earning money. Most of the time the market is positive, so you are actually earning money, you are shorting something, you have hedged your risk. How is the other one better in any terms?
I think it's a good discussion. Basically, it comes down to trade-offs. Like perps and futures. Perps you have to pay funding rate. So in a way, that funding rate might pop at any time, and then you might have some unpredictability there. But for futures, if you do it, like you said, you have to roll it every single week. And I feel like it depends on how hands-on you want to be. But agree, there are definitely different trade-offs and a different sophisticated, target audiences will choose different ways. But it's very interesting, right? Like TradFi, there's no perps. Like there's a bunch of volume in options, in futures. But then in a crypto space, perps definitely dominates. It maybe, like Jeff says, has to do with the target audience, maybe participators, the players. But what does that mean for the future? Would that start to change like more towards DeFi or more towards TradFi or? Actually, like only a few minutes left. A last question for you guys. What do you guys want to see in the next couple of years for the DeFi options or DeFi derivative space?
I want to see better capital efficiency.
Yeah, same. I guess the problem that everybody faces with options, at least. And actually, I want to see more. So DeFi is all about composability, right? So for example, Pods is working with Rysk to build our own structured products. Maybe someone like Polynomial will create another product that we can build on top. So I'm very excited to see these new products that allow us to build these money Legos. Yeah.
It just happens all the time. Yeah, we've been a big proponent of that. Like most of the products that we make are built on top of synthetics. So like we are more into like why make something from scratch. But in general, like what I want to see is like better blockchains, faster and less costly. Like most of the time you try to scale a product, it's just gas price goes up so much. It's really annoying. And so better infrastructure would be something that would be really good. And more innovative stuff, like people are not creating cool stuff this year. Last year it was a little bit better, I think. This year not enough, so somebody make something really nice. That would be very good.
Maybe next 5 minutes, okay. Next competitive edge for the research is maybe like perpetual, between perpetual and then fixed term. This bridging this area is waiting some like a genius making the paper, and then we want to develop those smart contracts. Thank you.
I guess I'll add on to, as a trader, capital efficiency or like counterparty risk and all those things matters. Right now people worry about the centralized exchanges. There are different solutions such as, the Copper Clearloop, Fireblocks, like Binance, Seifu. Maybe I shouldn't mention them together, but in a way, people want to use their own wallet somewhere they can see and then mirror the assets over to exchanges. Maybe we'll see that it would be great to see that combined with the DeFi where, hey, imagine you have a wallet and your asset can mirror to centralized exchanges and a DeFi platform at the same place, so that if they call their different prices, anyone can take advantage of this and easily, trade them. I guess goes back to capital efficiency and make it, less friction to trade or to speculate or to take advantage of the market. I guess let me squeeze in one last question. Any advice for anyone who wants to get into the derivative space, whether it's developers or just new projects?
I'd say best bet is always to try and solve the hardest problem. So right now I'd say that is how we get volatility on chain, portfolio margining, and capital efficiency.
I guess, so the biggest thing Pods learned with Options AMM is that you have to talk to users. We spent 2 years building the Options AMM to then talk to users to realize that we were actually on a limbo. It was too easy for advanced users, too complex for new users. So before you build something, talk to users first, learn from our mistakes, because otherwise, you're gonna not waste time, because it was very fun, 2 years building the AMM, but you could build something that has a better go-to-market, that has PMF. Yeah, because in the end, we're all looking for PMF, right? So yeah, talk to users. I guess this is where the most important information is, because without users, you don't really have a product. So yeah.
Hello. Yeah, so I would say so the biggest issue building something on chain is that contracts are very risky. You need to go through 2-3 audits. You have a very large development cycle in general. So it's like 5-6 months. So most of the time people just think of an idea and they just start building it for 6 months. I would say make it internally at least, see how it is, go to a hackathon, show it to a bunch of people, see if it works, and make a bunch of new things, right? Iteration is as important. If you're trying to do the same thing and your iteration cycle is 1 year, and if someone else's iteration cycle is every week, the person who's doing 1 week and then just slowly improving will be better in a year than someone who's just building in their back room, because you don't know a lot of things. Will users like it? Will this be good? So we need to figure out a way to do it in a very elegant way. It's not done yet, but there needs to be make a bunch of stuff. I think that would be the best thing that I would say.
Yeah, I just hoping not only DeFi, all user please use to the smart contract. Transaction on the MetaMask, even any is fine, because right now even I go to the investor institutional people, and then last month I go there, and then funds manager say our minimum lot is 50 million US. Current DeFi is too small, they say. To be honest, one of the insurance company's funds manager said like that. First, if they use to the smart contract, then because for them 50 million is for us or even me, I don't know you guys, but for me 50 million is huge money, but for them is no. If they use to the smart contract, they can put the money, and then we have a minimum liquidity, then we can develop. Liquidity is like infrastructure. So I hope is anyone used to the smart contract is much important. Yeah.
Okay, all right.
Okay, so we can open for some questions for our panelists and our host. Okay.
Just more like comments. I think one comment was now the treasuries are paying 45%. Why are you getting yield from DeFi? But in DeFi, like ETH staking is like 4% plus, and I think other protocols staking reward is also higher than that. So I think it's people's mentality of like thinking in terms of USD all the time. So if they're accumulating native tokens, then it's not bad. So that was just a comment for that. And regarding the dated futures, what about CME futures? That's pretty popular, right? So the institutions, they seem to be used to data futures, even crypto data futures, and there are even ETFs built on top of it. So just throwing it out there.
Yeah, just to add to that on the USD 4% stuff, I think people put a lot of emphasis on the US dollar for some reason, and I think a big thing about DeFi is accessibility. So like, a lot of people, while they see that 4%, I personally wouldn't even know how to access that. Whereas with DeFi, it's very easy for me to know, oh, I need to go to Aerhy to get this, or I need to go to Lido to get this. So it's sort of, accessibility is a major thing about the that US Treasury argument that you hear a lot. And another thing is that a lot of you DeFi users wouldn't even get out of bed for 4%. So yeah, that's another thing as well.
Thanks, everyone. So one of my question is kind of like a follow-up from what you guys have been talking about. One of the main point was around GMX. Does that actually, is that product market fit? Are those users actually the user you want in the future, right? Because Jib was saying, they're not that sophisticated. They don't even know how much fee they're paying. So I guess like my question is to every one of you, because you're coming from different teams, what are your teams trying to onboard next? Are you trying to, kind of like bring mass adoption with, the simplest UI, DeFi newbies into derivative or option trading? Or are you guys trying to bring the most or like more sophisticated CeFi traders on chain, and why is that?
So yeah, retail, we're already onboarding. They tend to be the easiest people to onboard, just because it's much easier to educate them. When it comes to institutional, what we've found typically is that they are very skeptical about regulatory issues, about smart contract risk, and so they tend to not sort of be harder to pitch and to get on board. You can only really ever sell them something which they don't have to hold for too long. They wouldn't like LP, for example. And then so the next for us, to be honest, is more around protocols and how we can sort of get, build this sort of thesis of collaboration before competition, so protocols hedging with each other. So for Rysk, I'd say we're mainly focusing on protocols after retail.
So for pods, so our strategies, they are very low risk, principal protected. So in DeFi, it's not very attractive, let's say. But we do think that, of course, if I have a lot of degen strategies, degen protocols, and these kind of low risk strategies are also necessary to onboard people that are actually scared. For example, I don't use power perps because it's complex to understand. I would not recommend it to my sister, for example. But that is principal protected, and I feel like it kind of makes it easier. It's like kind of lowers the entry barrier. These low risk strategies. So there's that on retail, and we're also focusing on DAOs, so DAO treasuries, because of course they have their own tokens, and sometimes they have USDC, ETH, and that money is their runway, right? They pay their their contributors with that money, so they have to protect it as much as possible. So we do think that low risk strategies, principal protected, is a good strategy for them. So we're also going after them. So yeah, mainly DAOs and retail, more for like new users into DeFi.
So in terms of user focus, we are like of all the products that we have, like we are majorly focused on perps at the moment because they have a lot more adoption, and so we built something on top of synthetics perps, and essentially it has lower fees than GMX. So I think we are trying to get people from there, but the product by design is not good for people trading less than 10K. So we are trying to go for users about $10,000. So I think the idea is to get rid of airdrop farmers and then get everyone else. And so that is generally the focus for us at the moment, like a little bit sophisticated, and we're not majorly focused on institutions because it hasn't been like a good past experience, and I feel like in the long term people who become like big institutions in crypto would be crypto native people rather than bringing all these TradeFi people who don't even understand how these things work. So like there will be some people like native funds who come up big, become big, and hopefully don't get liquidated.
Our strategy? We are focusing like because we are a very small team. To be honest, is our team is only 3 people. To be honest. Then, of course, if we have enough money, enough human resource, we can consider a lot of choice. But in fact, we are 3. And then what we need to do or what we can do, we must consider. So right now is we are focusing the crypto trading firm only. If we want to provide the product what they want. Like only 3 or 4 company, crypto trading company, we like monthly, we approach them. We made this one. We made this one. Do you want to trade like this one? That's what we are doing now.
Okay, if there is no question, please give big claps to our panelists and hosts for giving this great panel. Thank you. And thanks everyone for participating in the first day of East Taipei Conference. One important reminder here, please bring your badge tomorrow. You can only enter the venue with your badge. See you guys tomorrow.